Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to go through a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship, the parent having a controlling interest. Thus, we're going to have a consolidation, but not 100% owned, so we will have a non-controlling interest. We're also going to have a loss on intercompany transfer of equipment. This is where our focus will be. We've had a transfer of equipment in prior problems, but typically when that happens, we often have a gain in the transaction, this time having a loss in the transaction. Get ready to account with Advanced Financial Accounting. Here is the data for our practice problem. We're going to read through the data first, and then we'll take pieces of that data as we go through and enter this information into our practice problem. We have P purchased a percentage of S voting stock, so that means P is going to be the parent, S is going to be the subsidiary. The common stock was purchased on December 31st, 2000 X0. The percentage purchased was 75%, that then being the controlling interest, non-controlling interest, of course, then at 25%. The cost that was paid for the 75% interest was $2,220,000. Non-controlling interest then at the $740,000, the fair value of the non-controlling interest at the point of purchase at 2000 X0. Then the net assets, or assets minus liability, or the equity section as of 2000 X0 of S, when that was purchased, was the $2,750,000. We're going to be using the fully adjusted equity method. The consolidation will happen as of 2000 X7. So note that substantially after the purchase, which is X0. So 7 years later is the consolidation. So this is a while after the actual purchase took place. Book value and fair value of assets and liabilities are the same, except for, in other words, at the point of purchase in 2000 X0, if we take a look at the individual book value for the individual accounts and compare them to fair value, they would be the same, we're saying, except for inventory. Inventory had a greater value of $52,500. Land was greater by the $73,500, and goodwill, there was goodwill that we're going to calculate. We'll get back to goodwill of $84,000. Then the 2000 X1, P sold land to S. So P sold land to S. It happened in 2000 X1, so that was a while ago, and we're just going to be given the gain here. So the gain's being given to us at the $29,400. January 1st, 2000 X7, S sold machinery to P, so depreciable property to P. This is where our focus will be. So P purchased it 5 years ago, 5 years earlier for $450,000. So that's how much P purchased it for. The book value now is $300,000 as of the point in time that it was sold. It was sold in 2000 X7. That's the current year of the consolidation we will be working on. Useful life was 15 years. So 15 years from the point that it was originally purchased, which was 5 years before 2000 X7. So we'll calculate the depreciation on it. And then the sales price was $260,000. This is going to result in a loss to us, so that's going to be the kind of the new thing we'll be working with. Differential assigned to goodwill, starting 2000 X5, intercompany services from P to S for a fee each year of $92,000. So we're going to say that there was services provided from P to S, and there's going to be fees for them of $92,000, another intercompany type of transaction, but there's no physical thing that's changing hands or going from one to the other, such as inventory, such as land, such as equipment. So that'll be a bit easier for us to deal with. December 31st, 2000 X7, S owed P $23,000. So that's a payable and receivable that we'll have to reverse out. All right, let's start with our standard table up top. This is going to be our table that we typically will look to adjust the first adjusting entry. So we want to think about this table as we start to put together our data. Typically, when putting together the data, we're thinking about the types of things that will affect the income statement that we may be including in our table. In this example, we're talking about a loss on the equipment, if there was a gain or a loss, and the related depreciation for the equipment, because that's in the current year. Land happened in a prior year we'll have to deal with, but it's not in the current year, so it's not really affecting the income statement in the current year. We do have a difference in the sales price and the price that the fair market value at the point of purchase in 2000 X0. But again, that's not something on the income statement for the current period, therefore not in the table such as this. This table typically will start out with, let's pull out the trusty calculator. We have our data on the right. This is going to be P parent company, S subsidiary. This is their trial balances as of the day we are consolidating 2000X7. If we look at P's books down below, we've got revenue as a credit, then the expenses here. That is net income. Net income then for S is 179,000. That's typically our starting point for our table for our first journal entry. So then we would take that 179,000 times 0.7, was it? I think it was 75. 179,000 times 0.75. That's going to give us our 134,250 because that's the controlling interest percent. 179,000 times 0.25 non-controlling interest percent, the 44,750. Then we're going to have our starting point for the book value. So we're going to start our table here, and that's going to be either assets green minus the liabilities or all of the equity section. Let's add that up real quick just to check that out. 77,000 plus 69,400 plus 2279 plus 129,000 plus 3080,000 minus 412,000 minus 52,000 minus 500,300. And that's going to give us the 3,699,000. We're going to get the same thing if we did the the blue numbers down at the bottom. So we can just do that real quick. 930,000 plus 128,000 plus 1330. That's not right. 1330,000 minus 20,000. Then I'm just going to pick up the net income down below the 179,000. So that's going to be the same 3,699. If we take the controlling interest percent, multiplying that times 0.75, 75%, we get the 2,774,250. If we took that same number, the 3,699,000 times the non-controlling interest, or 25%, we get the 924,750. All right, then let's scroll on down. Next item we want to do is our Goodwill calculation. So I've added a little reveal box here because that's more exciting, a little mystery for our items. So we're going to say that's going to start off with the net assets of S. So we got our information from the information up top. We're just going to take the piece that is applicable now. The net assets of at purchase being the 2,750,000. So we're going to take that amount, and then we're going to look at our differential. The differential was 126,000. So that was in our data as well, and we're going to say that there was a difference between inventory, land, and then they gave us goodwill as the differential calculation. So we're taking the 52.5 here and the 73.5 for the inventory and land. Difference between the book value and fair value, the 126. We will get to the goodwill at the end of this calculation. So then we have, that's going to be the fair value, the 2,876,000. Then we're going to have the non-controlling interest given to us at the 740,000. So then if we subtract those two out, you would think that would be the amount for the controlling interest, the amount of the controlling interest if there was no goodwill, but there is because the payment was 2,220,000. Therefore, we've got the goodwill of the 84,000, in essence, recalculating the goodwill that they gave to us down below. Now, of this differential now, the differential is the 126 and the 84,000, or you can see it over here, the 52.5 inventory, land, and goodwill. The inventory is the one's a little bit funny because it's going to basically reverse out. So we expect the inventory to sell, and then that part of the differential will then, in essence, go away. Now we're going to think about the sale of the machinery. So here's the information related to the sale of the machinery, and let's just kind of break this down in terms of the gain and the loss, and then we'll take a look at the journal entries that will be recorded on S and P's books. So this is going to be a sale from S to P, so it's going to go from the subsidiary to the parent, so upstream sale. We got the sale of machinery S to P. We're going to say the sales price is going to be the 260. Sorry, I'm scrolling around a lot, but that's going to be the 260,000. The book value we will then calculate, the cost being the 450,000, which is given above. Then we have the accumulated depreciation on that of the 150,000. The difference between the two is the 300,000. Therefore, the sales price of the 260 minus the book value is a loss now. So now we have a loss here on this intercompany transaction of the 40,000. So then we can think, okay, well, what would happen on the books of these two companies? Because obviously we're going to consolidate together. And in that case, it seems like this basically was a sale to themselves in the current year that we're going to consolidate. So let's see what happens, because you'd think we would need to reverse it. So S journal entry, S we're going to say is the seller here. So they had a debit to cash of $260,000. They credited the machinery off the books at the cost, the purchase price, to $450,000. Then they had to take off the books the related $150 for accumulated depreciation. That $450 minus the $150 is the book value. Then the difference is now a loss, because it's in the debit side, acting kind of like an expense, loss of the $40,000. Okay, well, what happens on P side, the purchaser of the equipment in this intercompany kind of transaction that we're talking about? Well, the machinery would go on the books for what it was purchased for, $260,000, and the cash would be $260,000. So you would think if we're going to reverse this, because they sold it to themselves, that this is an intercompany kind of thing, if we consolidate them together, you could say, hey, we should reverse these entire things, these entire two journal entries. However, we could break this out a little bit more easily. We could say cash is going to net out to cash down below. The machinery is going to net out to the machinery and leave a difference of the $190,000. So we're going to have to deal with that $190,000, and it should be on the books still for $450, but now it's only on the books for $260 because it went on the books at the net book value, and it went off the books at cost because then there was this accumulated depreciation. So we got to increase that account by the difference. Then the accumulated depreciation, which we took off the books, really shouldn't have taken off the books because it should still be there because we sold it to ourselves. So we got to then put that back on the books. So we're going to put that back on the books. And then we've got, of course, the loss we're going to have to deal with, which we will have to deal with because that happened in the current period, affecting the income statement that we're trying to consolidate here. So now we've got S having this loss that we got to take off of the books. Then we also have to deal with the fact that now we have this loss. That means that if you think about this, the machinery and the equipment is now on the books for a book value of $260,000, and that's $40,000 less than the book value it was on before, which was the $450 minus the $150, or the $300,000. So that means that they're going to depreciate not enough. They're going to have the $40,000 less here is going to result in depreciation that is not recorded that should have been recorded, which is different, the reverse of what would happen if there was a gain. So it's kind of like the new thing here. So so then if we took the added book value, this shouldn't be added, this should be the lesser book value. So that, scratch that word. And then we've got the useful life as 10 years. We're going to have the extra depreciation of the $4,000. So we're going to have $4,000 of depreciation that we're going to have to deal with, which should be on the books, which wasn't on the books due to this transaction. Okay, so now what we're going to end up doing is we want to basically recreate this number. So we've in the past we've recreated this number a few times because we could do that with the equity method. These are the two numbers that we have to deconstruct in order to basically reverse or do our reversing entries. So instead of going from start to finish to get to this number, which means basically doing the equity method from the point in time that the purchase took place, which was 7 years ago, we're going to kind of start at the end and see if we can back into this number so we can see how we can reverse things out to make this basically zero for the consolidation process. So first, let's think about the differential. What's the differential consisting of? You'll recall that it was consisting of these three items: the inventory, land, goodwill. So the starting differential was the $210,000. But then this $52,500 it went away because that was inventory. So the inventory at the time of purchase was overstated. Was not. We needed to increase the value of the inventory, but then the inventory was sold, so that inventory is gone. So it's no longer really included in some of the differential. In other words, it's not something on the books for something less than what it should be on the books for. It's been sold. So now the differential is going to be subtracting that, or the $157,500, or in other words, just simply made up of the land and the goodwill. So we got the differential. Now we're going to be calculating this number. So it's going to be our bottom line number here. Let me put a little reveal thing on. So now we've got the little reveal thing for some more suspense we have here. So then we have the net assets as of December 31st, 2000 x 7. So the net assets you can calculate as the assets minus the liability. So if we're going to take out the trusty calculator once again, we're going to say, all right, let's do this again. 77,000 plus the 69,400 plus the 2,279 plus the 1,209,000 plus the 3,080,000 minus the 4,12,000 minus the 52 minus the 5,003,000, and that's going to be the 3,699,000. You can do the same thing with the equity section. I won't do it here. We did it in that last table we worked on, but that'll be our starting point. Then we're going to be taking the controlling interest percentage of that, 75%, and that would give us the book value of the shares held by P. So you would think then that that would be what would be recorded here on P's books for the investment in S, if S's books were reflecting everything they should be reflecting, but they're not, because in the consolidation process we're going to make changes to it. So we're going to have to say that's what it would have been, but then there's this remaining differential we have to deal with, which we calculated up top. The remaining differential of, where it's the differential we calculated up top. There it is. We're going to take the 157.5 times 0.75%, and that's going to give us our 118,125. Then we have the deferred gain on downstream sale of land. That was given to us in the data. So here's the data. We have this gain resulting, but the gain rolled into the equity section. So instead of us adjusting basically this number, we're adjusting the investment side, the equity side only. So we've got that is going to have to be dealt with. And notice it's a downstream sale. So we took the entire amount, meaning it went from P to S downstream, therefore not taking the 75% of it, but the full amount. Loss on the sale of the equipment, the 30,000. So that's something we calculated up top. Up here, we had the loss of 40,000. And this was an upstream sale. So from S to P, therefore we're going to take the percentage of it. So we've got 40,000 times 0.75, which is going to be the 30,000. So that's the 30,000 there. And then we have the reverse part of the loss for the depreciation. So same thing. Up top, we got this loss, the extra depreciation in essence we have to deal with. Once again, we're going to take the 75%. And that's going to be the 3,000. And that gives us then, at the end of the day, once the day has ended, the sun goes down, we've got the 2889975, which is of course the 2774250 plus the 118125 minus the 29400 plus the 3000 minus the 3000, and there's the 2889975. Okay, so then let's go down to our table. Now that we have all this data, we're going to go down to our adjusting table for the beginning or first journal entry. So let's add our little reveal thing here. Reveal thing. So we started off, you'll recall, with the net income that will be allocated. So the net income here is our starting point, was allocated 25%. Now we've got our loss on the equipment, which was that 40,000. So same 40,000 we saw up top. Here, the 40,000, the 4,000 are the ones we're going to deal with. So there they are. So 40,000, and we're breaking that out between P and the non-controlling interest. Now note, again, this side, we're looking at kind of those things that affected the income statement. This happened in the current year. This is a loss. It hit the income statement. So we're adjusting the income statement side of things. Now 40,000, 75%, 30,000, and the non-controlling interest, then the 10,000. Then we have the depreciation. So depreciation not recognized is the 4,000. So the 4,000 broken out 75, 25, 3,000, and 1,000. Then we've got the income to be eliminated here. So if we were to add this up, of course, we've have the 179,000 plus the 40,000 minus the 4,000. There's the 215. We've got the 134,250 plus the 30 minus the 3. There's the 161,250. Then we're going to take a look at the balance sheet side of things. We have the ending book value. So here's the balance sheet, which is the assets minus the liabilities that we looked at before, broken out 75-25, 75-25 breakout. Same filler, same middle part that we're going to be using, that being these two numbers up top, or all of this. We're just going to say the same stuff down here. It's going to be the other side of the journal entry in essence. And that gives us our ending numbers, this plus this minus this, plus this minus this, this plus that minus that. Gives us our three ending numbers there. We're going to use that to adjust our first journal entry that we will be recording. And here it is. Here is that first journal entry. So let's do the little reveal thing. And we'll put that there. And we're going to say, all right, so now let's take a look at our actual journal entries. So the journal entries, here's what we have thus far. We've got P, we've got S. We then have the total, which is adding P and S together. That's our starting point. Here's the consolidation or elimination entries. They are including the current journal entry and any prior journal entries. We only have one thus far that we have done to this point. Remember, as we consolidate, this is going to go to 0. This is going to go to 0. I typically start with the investment account, first one we see, but let's ignore the number for now. We'll be back to that number in the future. Let's remove the common stock. So the common stock is here. So S's common stock, in essence, needs to go to 0. That's on the books as a credit. We're going to do the opposite thing to it, debiting it to make it go down. The additional paid in capital on the books as a credit. We're going to do the opposite thing to it to make it go down. Retained earnings is on the books as a credit. We're going to do the opposite thing to it to make it go down. And then, of course, the dividends on the books as a debit. We're going to do the opposite thing to it, a credit, to make it go down. Taking a look at what we have thus far then, here's going to be basically the equity section for P, equity section for S, the combined equity section, P and S. Here's us posting these entries, removing, in essence, S, getting us back to P. So these numbers here basically reflecting P's numbers. Standard procedure, that's kind of the same stuff we've seen in pretty much all these types of problems. Then the income from S. That's usually allocating this income, S's income, revenue minus expenses, on the controlling, non-controlling interest, 75/25. But this time, well, let's do that. 179,000 times 0.75 would be 134,250. That's what we would have used. But now we're going to use our table down here. We're going to say, well, P here, we would have used that 134,250, but now we're using, because of these adjustments, the 161,250. So we've changed that to 161 and we made it green to indicate that that number came from the table. And then we're going to go to the second component, which is going to be that we usually do 179,000 times the non-controlling interest, or 0.25, for the 44,750, but we're going to change it due to the table. It was 44,750, but now we're changing it to 53,750, and that's why it's orange. So now it's orange to reflect that. Then we've got the non-controlling interest on the balance sheet side of things, which you could say the net assets or the equity section. Let's add up the equity section this time. You can add up, assets minus liabilities of the equity section down here. Let's do the equity section. Might be a little faster. Plus the 128,000 plus the 133,000 minus 20,000, and then I'm going to add net income 179. That's going to be the 3669, which you'll see down here in the table. Usually we would take that and multiply it times the non-controlling interest times the 0.25, and that's what we would get. But no, we're taking the table. That's what we had up top, but we're adjusting it now to the 933,750. So now we're taking the 933,750, and then this number, usually we would take that same net asset number of the 3699000 and multiply that times 0.75, and that's what we would normally put there. But we're not, once again, because we changed it from that number to this number with our table. So that's what we're putting there. So in other words, this middle component here, all this stuff in the middle, used to be equal to the assets minus the liabilities, or this 3669,000. Now all the stuff in the middle, because we changed these two numbers, is equal to this number, 3735, which we're breaking out controlling, non-controlling 75/25 between the non-controlling interest in NA, net assets, and the investment in S. All right, that's our first journal entry, one of the major kind of components. You'll see that it does bring this one down to 0. That's what we're hoping to happen. This one's not quite there. The investment account is posted up top. As we can see, we saw the posting of these items. The income from S is being posted here. So there it is, bringing that down to 0. That's exciting to see. And then the income non-controlling interest is down here. And then non-controlling interest in A being posted up top right there. All right, what's the next one we have? Let's bring the little thing down here in case we need the reveal thing. So here's what we've done before. There's the prior journal entry. It's being included in here in the elimination column. This is the current item that we are working with. So let's bring the reveal thing down. You already saw it, but it's still good, even if you already saw it, to like cover it up, because then, all right. So now we're going to be adding those things that were the differential. So the differential when we first purchased when P purchased S like 7 years ago in 2000 X0, we had then this differential, which was inventory, land, and goodwill. But then the inventory was sold, we assume, later because it's been 7 years. So that should be sold. And then the differential now should just be the land and the goodwill. So we're going to have to put those on the books because they should still be higher by the original differential. So we're going to put the land on the books, and we're going to increase it by the $75,500, which is a debit. And we're going to put the goodwill on the books and increase it by the $84,000, which is a debit. And then we're going to put the other side to basically the split on the balance sheet side of things between the controlling and the non-controlling interest, which is the investment account and the non-controlling interest in NA. So we'll do our 75-25, good old 75-25 split there. So let's just pull out the trusty calculator. 73500 plus 84000 times 0.75. There's the 118125. And then we're going to take the 73500 plus the 84000 times 0.25. And there's the 39375. That being posted then is going to go up here. The land is going up for that differential. And the goodwill is going up. Will is good for the 84,000. Then the investment is going to be down here. There's a goodwill and there's a badwill. Okay, the investment's going to be going here up top. It's included in this number. And then we have the non-controlling interest, which goes there. Okay, scrolling down, let's see what else we have. We've got our information thus far. This is what we've got. It's being posted or is included in the posting over here. We're going to have 3 journal entries that we'll take a look at. We got the little reveal thing, so we're going to reveal them one at a time. They're already posted in this column to the right. Now, to do this, let's take a look at this information where it says starting in 2000 X5, intercompany services from P to S for a fee each year of $92,000. As of December 31st, 2000 X7, S owes P $23,000. So that means that we got services happening. So there's an intercompany transaction happening, but it's services, so there's no inventory going from one to the other. So it should be an easier thing to do, but let's analyze it in a similar way as we did with the other intercompany transactions, such as land and equipment. So if it's going from P to S, so what would happen in terms of transactions? Well, on P's books, we're going to say there's still $23,000 that wasn't received. So you would think, all right, well, sales must have gone up then by the $92,000 because that's the agreement. And then cash would have been received, or, we still are owed $23,000. So that means we only got cash of the $69,000. That's what you would expect to be on P's books. And then on S's books, you would expect then that they have an expense of the $92,000, even though they haven't paid for it yet. And the accounts payable would include that $23,000 that they owe. And then the cash would be the difference, once again, of the $69,000. Now, we would think we would have to reverse these out entirely, but of course, cash is going to net each other out, so we don't really need to reverse that. And then we've got the 2 things we do need to kind of reverse. Accounts receivable is overstated. The other side of accounts receivable is accounts payable. So we have those interrelated accounts. We can kind of pull those apart and think of them as their own journal entry. We should be able to verify those 2 accounts by looking on the books of P subledger to see that P owes S. We should be able to look on S's subledger for the accounts payable. I'm sorry, P subledger to see that S owes P, and then S's subledger to see that SOP. Okay, so we should be able to, hopefully I said that the right way, I'm not quite sure, but anyway, you know what I'm talking about. So we should be able to reverse that, and then we should be able to reverse the income statement side of things, because this is a transaction that happened in the current year, and so we can tie those things together, which is basically the sales and the expense should just reverse out exactly, which is much easier than if there was something that was actually physically sold, such as inventory, such as land, such as equipment, and depreciation and whatnot. So this should be an easier thing to deal with. So that means we have these differentials, accounts receivable, which we can tie to accounts payable, sales, and expenses. So that's how we're going to break these two out. We're going to tie the AR and the AP together, the sales and the expenses together to reverse them out. So let's do that up top. We're going to say we'll remove the income side of things. So we've got the other income. Income is a credit balance account. Therefore, we're going to debit it to remove it. So we'll debit the income. And then the other side is going to go to the expenses. The expenses being removed, it's a debit balance account. So we'll do the opposite and credit it to remove the expenses. That then being recorded here. So other income going down. Other expenses going down. Clearly, this isn't the only thing in other expenses, but it's going down by those intercompany expenses. Then we'll remove the receivable and payable. This is just like those intercompany transactions we've seen in the past, which we should be able to determine by simply looking at the subledgers that would be in accounts payable and receivable for P and S. And we're going to say, all right, accounts payable needs to go down. So we're going to remove that by doing the opposite thing to it, a debit. Accounts receivable needs to go down, so we will remove that by doing the opposite thing to it, a credit, recording this amount here for the receivable, this amount there for the payable. Next transaction, scrolling on down, we got what we have done thus far, that being included in the consolidation or elimination column here. Then we have the investment in S and the land. In other words, we have this gain on land. They gave us the $29,400 gain in a prior period. Obviously, if we were doing this in practice, we would still have this left over from, we can look at the last year's consolidation worksheet, and we'd see transactions related to the land, which the gain happened in a prior year, so it rolled into retained earnings, so we're not dealing with the income statement side. We are, in essence, increasing decrease, let's think about decreasing the land. The land needs to go down because it's overstated by the gain of $29,400, so we decrease then the land, so that's going to be included in this item. And then we are going to be putting the other side into the investment account. So it's going directly into the investment because it was a downstream sale, P to S, therefore no split, no 75-25 split, going all in the full amount into the investment account, which would be included, of course, in this number. So now you can see that the investment account and the income from S now add 0, good signs. Let's take a look at the machinery transaction. Now I'm going to move our reveal. We got the same thing. We got what we've done thus far on the upper left. We included that in the consolidation entries to the right. Now we're going to be dealing with the machinery that we're going to, that happened in the current year where we had actually a loss. Let's review the transaction very quickly. We got the sale of machinery from S to P. So it's going to be an upstream transaction, S to P, sales price $260,000. Book value is going to be calculated as the cost, $450, minus the accumulated depreciation at the point in time of the sale, $150, bringing the book value to $300,000. Because the book value is greater than the sales price, we have a loss that is a result of that, of the $40,000. It is an intercompany transaction. What would happen to the two company books in this transaction? As journal entry would be debit the cash, $260,000, credit the machinery to take it off the books, $450, debit the related accumulated depreciation, the $450 minus the $150 would be the book value. That compared to the cash means that there's a difference of the $40,000, which is a loss in this case. On P's side, the purchaser side, they would have recorded the machinery on the books at the price that they purchased it for, $260, and then the cash would be the other side of the transaction there. If we look at these two transactions to reverse them, cash nets out, so there's nothing we would really need to do there. The machinery then nets out, but we still have that difference that we're going to have to put back on the books. So we're going to have to put that difference back on the books. The accumulated depreciation, we're going to have to put back on the books. And then the loss is we're going to have to remove the loss because it happened in the current year and there was no actual loss that took place. So here are the differences. Machinery will have to be increased by the $150. Accumulated depreciation will need to go back on the books for the the $190 machinery, $150 for the accumulated depreciation, and then the loss. of the 40,000. Now we know that there's going to be a loss in the 40,000 resulted in, or what happened here is we also know that the machinery is on the books at the 260 book value, which it was on the books for more than that, 300,000. In other words, the book value was 300,000. So that means that it's on the books for $40,000 less, resulting in the depreciation on that 40,000 not being recorded, which should have been recorded. So we actually need to increase the depreciation by 4,000 because we're going to take that 40,000 divided by 10. That's going to give us our 4,000. So we're going to have to add the depreciation. We're going to have to add these items using the journal entries up top. So that's going to be what this will consist of. So the machinery is going to go back on the books for the 190, debiting the 190. The related accumulated depreciation is going to have to go back on the books. It's got a credit balance, so we're going to credit it by 150,000. Then we have the gain or loss that's going to have to go off the books. So gain or loss was included in this account down here. It needs to be removed now. Gain had a debit balance. We're going to remove it with a credit. I'm sorry, the loss has a debit balance. We're going to remove it with a credit. So we got the cat and we got the machinery up top. Here's the machinery. It's included in this number. Then we have the accumulated depreciation. There's the accumulated depreciation included in this number. Then we have the gain loss that's going to be down here. So this number included the 40,000 gain or loss, which we're now reversing. So obviously there was more in there than just related to this transaction, but we're removing the 40,000, eliminating the loss as a result of this transaction. Okay, and then we're going to record the depreciation, which is just normal depreciation entry because there was some part of the depreciation that didn't get recorded. Normal depreciation entry being debit depreciation expense, credit accumulated depreciation. So here's the depreciation expense going up. Accumulated depreciation would then go up top, included in this amount up top. So that's it. Note check figures. We see these two accounts down to zero. That's a good sign. We see that in the equity section, the P's equity is basically the same as the ending equity. Also a good sign.